Hey everyone, we've got a brand new episode of In the Money with Amber Kanwar. Listen, the headlines are totally nuts, and I'm not going to pretend to keep up with them because they change every hour. But this episode, we're just talking about how to find the best businesses on the planet. What are they, and what is the criteria? We've got Paul Harris of Harris Douglas coming up. It's a great episode, so I hope you'll tune in. If you're enjoying the podcast, you're watching us on YouTube, give us a subscribe, tell your friends, tell your parents. They're my people. Let's get into it. The information provided in this podcast is for informational purposes only and does not constitute financial, investment, or professional advice. The views expressed by the host and guests are their own and do not necessarily reflect the opinions of any organization or company. The host and the guests may maintain positions in any securities discussed on the podcast. Always consult a qualified financial advisor or professional before making any investment decisions. This episode is sponsored by BMO InvestorLine. Investing can be intimidating, but it doesn't have to be. With BMO InvestorLine, you have the tools and resources you need to make informed decisions and build a successful portfolio. Their easy-to-use platform, packed with research tools and commission-free trading on over 100 popular ETFs, can help you take control of your financial future. Learn more at bmo.com/online investing. Paul Harris, thank you so much for joining me in studio.
My pleasure. Thank you for inviting me.
So we film this on a Monday and we turn it around in less than 24 hours. And you would think that that would be enough time to capture the news.
Right.
But we don't know. And I still don't know. Are we going to have tariffs? Are they going to be 25%? How long are they going to be in place? That matters for this show. I imagine for you managing money, maybe that matters a little bit more.
Well, I guess my issue with all this stuff is that it's the unpredictability of everything that he does, right? So it's not so much that you're going to have tariffs, because if you have tariffs, everybody will kind of get used to them and deal with them, and the market will adjust to what has to happen. The reality is, for me, whether we have tariffs or we don't have tariffs, it's a self-fulfilling prophecy, because what's going to happen with businesses is that they're just not going to do anything. Like if you're unsure in this world we live in today, you're not going to expand, you're not going to hire people, you're not going to do all these things. So the Canadian economy, effectively, in a funny kind of way, and the US economy as well, will somewhat stand still, right? Because businesses can't make decisions, but they don't know what's going to happen. And so that is it's very detrimental to the global economy in many ways, and I don't think it's effective. Tariffs aren't an effective thing. We've built a world of free trade, and I guess the Americans feel that they've got a raw deal and all this stuff every time, but they built this world that we live in. They've put in all these things in case, but they're the people wanting to rip it down because they think they got a bad deal. What they actually got from all these things that they did is that they became the richest, most powerful country in the world by doing all these things, right? And they forget that all the time, right? So it's not what they created was something very brilliant after 1945, but the reality was that they feel they got a bad deal and that the Europeans are ripping them off, everybody's ripping them off. And it's okay to go renegotiate stuff, but to destroy it all makes no sense. And it's never going to be good for anybody.
And I think so many people argue till they're blue in the face about the logic of it. And this is not really about logic. You said it. It's just a negotiating tactic.
Yes. And it's not about logic, and it's not going to bring in any money to the United States. The last time he did it, didn't bring that much money in. And it just really hurts relationships. It hurts relationships, funnily enough, with all your allies. It doesn't hurt relationships with China maybe China does, or Russia or any of these other places, right? The Russian economy is nothing. Right, so you're really hurting your relationships with people you've built, who are your allies. It's an absurd thing to say, but that's exactly what you're doing, and that's, I think, bad for the world in the long run. And it doesn't really solve any problems, right?
So then, with all this absurdity, and it is absurd, why are markets very resilient? Yes, we've seen some pressure, but we're close to all-time highs. Europe is ripping. Even China's showing some momentum. So where's the disconnect between the headlines and what the markets are doing?
Well, I think the issue is that, as you know, and you've been in this business a long time, stock markets and any kind of investment markets kind of climb this wall of worry. And so people are just worried about all these things. So, the stock market continues to go up. And but in the European context or even the Chinese context, a lot of these things that people are saying to themselves, well, we kind of have to do it ourselves now. The Americans are not going to be around, and we have to grow and do other things to grow our economy to make it different, right? So I think that's part of the reason why you're seeing these other places do well. The other thing, of course, is that I think that people were fearful. We've had lower and lower rates, and I think there was some fear that although the Fed may not drop rates in the United States have come off in the last little while. So that's kind of helped the stock market as well. But I think the stock market is certainly not cheap at these levels. Like there are higher multiples, so there's a bigger risk of something happening that causes it to fall. And as you probably know, Amber, the stock market sort of goes up, a set of stairs, but it comes down in an elevator. And so that is the problem with the stock market today. It's far more volatile than it's ever been. And I think that what we have to understand is that at these multiples, a small shock, whatever that may be down the road, would probably cause it to fall a lot more than people think.
So what do you do with that in the portfolio?
Well, so the way we think about it is slightly different, right? What we think about is that, we always have about 10 to 12% cash in our portfolio. And so what we look at it as a strategic asset class, right? So where we can use it when things like this happen to buy companies we really want and better valuations. But the other thing is that when you have this kind of falls in the stock market, the cash protects you. So I'm of the view of the world is that if I can't outperform with 90% of my stocks and having 10% cash, then I'm probably not doing a good job. But it's this asset allocation decision that people have to make in their heads to say, I need to protect my downside. But, some people would say, well, I'm going to own, other kinds of asset classes. And I don't believe in that.
And I don't want to make it seem like the markets are totally ignoring what's going on. Like on a headline basis, for sure, it looks like the market is barely dented by tariffs. But then you look under the hood, what's outperforming? Gold, defensive sectors, risk on areas like tech have actually started to lag. So the fears are there. There is a bit more of a defensive posturing. Yeah,
and you can see that things like Bitcoin and all these things have come off a lot, right? So yeah, I think there's a feeling that there's a lot of risk in the stock market, and so I think that people have to be much more cautious about the companies they buy, but also thinking about asset allocation more to make sure that they're not, overly invested in the stock market in very high riskier stocks.
You also have to think about geographic exposure. Canada versus US is the age-old question. Canada's actually outperforming slightly thanks to its gold stocks. I just saw a downgrade today, though, of Air Canada, basically getting penalized for all the issues that's going on in Canada. Weaker Canadian dollar. Canadians don't want to travel to the U.S. The prospects in Canada aren't as good as they are in the U.S. Like, how do you think about that?
Yeah, so I don't really think about diversification. I think it's a very bad idea. And I've always thought it's a bad idea. So I don't think about, our portfolio is about 60% in the US, 40% in Canada. I just find better companies. So I look for companies, I find better companies in the United States. And it's a small country here. So you're not going to have as many great companies in this country. But so that's how I think about it. And, I don't really think about diversification into Asia or any of these other things. I think it's always been, that's more like a very institutional thing. And I think you're just diversifying away your returns, really, as far as I'm concerned. So why not, you're buying a mediocre company in another country just to diversify your risk away. So I've never liked this idea of being diversified internationally and all this stuff. I don't buy the data. It doesn't show you that you outperform. I think you're better to outperform by buying great businesses and owning
regardless of where they are on the planet.
Yeah, and I don't mind if it's in. I'm happy to buy a great business in Europe, a great business, but and letting it compound for you over periods of time, and not worry about exactly where that is, and having I've got to be in Asia for so much, and Europe for so much, and the US for so much, and stuff like that. It's where you find good companies. I mean, you find good companies in Canada. Don't get me wrong. But there's just not as many. That's all there is to it. That's just life, right?
So when people say, oh, the Canadian market's so cheap on a relative basis, it's at the steepest discount versus the US, you've got higher dividend opportunities, that's just not your framework. That's not how you look at the market.
No, I don't think so. And I don't think you should look at it that way because we're a very cyclical economy. So sometimes, yeah, it looks really cheap because it might be those cyclical stocks are very cheap, right? I don't play in cyclical companies because I think that they're just too hard for me. They're not great businesses. And I'm not trying to be mean about that. I'm just trying to say that they're just historically not great businesses. If you look at return on invested capital, you look at any metric that I think that would judge a really great business, they don't have them.
So does that mean you don't invest in gold?
I don't invest in gold. I don't invest in mining. I do invest in oil. Slightly different, I think. But I don't invest in those kind of cyclical stories, traditionally cyclical stories. Some people say, oh, well, you invest in banks and banks are cyclical, but they're substantially less cyclical than they were 30 years ago. I mean, I used to cover banks at TD Asset Management, and they were far more cyclical because they didn't have as much fee income as they do today. Right? Banks are far more diversified than they were 30 years ago in this country. So they're not as cyclical in nature as they were. Right? So it's okay to own them if you want to be in those kind of stocks.
So if you're looking for just the best companies on the planet, regardless of all the noise that's around, and of course you have to factor that into your thinking, what's on the checklist?
So there's a guy named his name is Hendrik Bessenmeyer, and he's a professor at ASU, Arizona State University, and he wrote a paper that says that all the returns from the U.S. stock market from 2019 I think he updated it was originally done to 2016 or 18 to 2022, came from 4% of the securities. So you know what? The stock market has a lot of lousy businesses in it. And my job, if I do it properly, is to look for great businesses. There's not that many of them. And we think about the stock market as always this thing that compounds. It really, most of the stocks in the S&P 500 have given you a return of T-bills outside of these kind of 4%. So the goal of a portfolio manager is not to kind of look at the stock market. People put money into the stock market, not because they're great businesses necessarily, but they create liquidity for you. You own a company, you want to get out of that business and become really, really rich, you go to the stock market, or you may be able to sell it privately, but the vast majority of people sell it to the stock market because they get a much higher multiple. So it doesn't mean it's a good business. It just means that you built a business, you want to get out of it, you sell it to the stock market. So there's not that many great businesses in the world, and you have to look for them, and it's a hard process to do. But it ends up being that you can't have a massive portfolio either. You tend to have a concentrated portfolio. So we own 27 stocks. So that's what happens and I think this argument that they make is, oh, there's only 7 stocks going up. Well, actually, they're kind of great businesses. That's why they're going up, right? It's not rocket science, right? And if you look at people like Warren Buffett and all these other people that are great investors, I only figured out by reading this guy later on, but intuitively they knew this, right? They know this. That's why they own less companies. They own them for long periods of time. They understand that those companies compound in their portfolio at extraordinary rates. And that's way better than buying a bunch of different things and buying and selling them.
So you brought up Warren Buffett. Have we run out of good companies? Because Warren Buffett's sitting on hundreds of billions of dollars in cash, record cash pile.
Right.
And why isn't he buying? Because valuation also matters.
Yeah, so valuation does matter. And so I think he probably sees that valuations are extreme. There may be other reasons why he's doing that. He's 94, 95, 94 years old. And, his world may change in the next little while. But so there's all kinds of reasons why he does that. And maybe also for him, he needs to make very large acquisitions to move the needle on his portfolio. So when he buys a stock, even if it's Bank of America, one of these things, yeah, that's fine, but it doesn't really move the needle. He needs to go and buy, a big railway or a big insurance company or all those kind of big deals that really move the needle on his businesses. So that may be the reason why he's created a lot of cash, because he sees valuations high and there'll be an opportunity to do that. But I don't, the problem with Warren Buffett is that we all talk about him. We all talk about it on TV like this or on your show and, on BNN and all these other things and put our little quotes of him on your website as if we all have breakfast with him every Saturday morning eating bacon and eggs. We don't, right? He's a businessman. He does what he wants to do. So, nobody knows his mind, what he's doing this for. But we kind of use him as a vehicle to market ourselves, I guess, right? But what he's really done, a lot of people say what he thinks he's done, but what he's really done is that he's bought great businesses, held them for the long period of time, and let them compound for him. And he says this in every report he writes, that's what he says, but nobody kind of believes him, and they kind of go buy other things and sell them and buy them. So that's his brain trust, is that he's done that. He's been able to do that. And he didn't do that originally, right? The first company he ever bought was Berkshire Hathaway, and it was a lousy business, right? He bought it at cash or something weird like that. I don't know what he bought it for, but he just realized, oh my God, this is a lousy business. I got it, and he couldn't get out of it. And so, sometimes I think that he just keeps the company name to remind him every morning that he bought a lousy business, right? So, buying lousy businesses are not good. Like you need to buy, and then until he met Charlie Munger, he really came around to buying great businesses at maybe not cheap multiples, but at a great price, a great valuation, not at a very low valuation, but an okay valuation. And so that's given him the ability to be a better investor, I think. And that's what you have to take away from a lot of the stuff he says. Right?
All right, well, let's see if we can find some of these great businesses and dip into the mailbag. Our first question in the mailbag is on TD. This one coming from Brian. What's your take on TD Bank, and will our Canadian banks be negatively affected by Trump's tariffs?
So we own TD Bank. We've owned it for a long time, sometimes suffered through it. But it's I think there's a unique opportunity in TD today because, one, they have a new CEO. They have new people that are heading off all their different divisions. They are not allowed to do acquisitions anymore in the United States. They can't really do any acquisitions in Canada.
In the retail chain.
Yes, in the retail chain,
yeah, okay.
Right? And so, which gives them a great opportunity, one, to really work on that retail chain to make it getting better returns on equity, because it wasn't, right? They've built a great franchise, but the returns on that franchise have not been good. The other thing is that they also made a bunch of acquisitions about other things that don't give them a very good return on invested capital. So they need to exit those businesses, which they're trying to do. The last thing I will say is, because they're forced to kind of think about risk management, they can actually become one of the best risk managers in the world if they do it properly. So there's a great opportunity with the stock. I don't think you're paying a lot for it on a price to book level or on a PE basis. And I think that sometimes not buying things forces you to become better at the things, work on the things you own, right? And so it doesn't stop them from, growing their investment bank and doing all this stuff. So I think that it's a great opportunity to buy the stock at these levels. I think you'll do very well with it over the next several years.
So it's actually in 2025 is the best performing bank stock. And I wonder if part of that also has to do with the fact that we've kind of gone back to this idea that now, again, we want Canadian banks with U.S. exposure. If you've got a relative view on the U.S. economy, then maybe you want to lean more into like a BMO and TD versus what has been working, which is like the Nationals and the CIBCs.
Yeah, so I think that is the case. I mean, I think that people want to have the exposure. I think the issue for Canadian banks is that when they've done businesses in the United States. So one of the benefits of what's going to happen with the Trump is that although there's these tariffs and all these other issues, they're also deregulating the financial services sector. So that would help like Royal and TD and all these other people as well. So there is a benefit to some of the stuff that's going to go on there. I think, if you can run a really good bank in the United States, you can do very well with it. Like, retail is a great business if it's run properly. And I think that TD's retail franchise is a great brand name, but it's not been run effectively for the type of rates of return that they need. And I think that's what they have to focus on. And so instead of focusing on the next acquisition that they were doing before, now they can just focus on, okay, let's make this a good bank, right? Maybe you have to sell off certain parts of it. That's fine.
And they sold their Schwab stake. Is there? You think there's more to?
Well, I mean, I think they bought, from the credit card side, they bought things for Target and all these other things, so they can get rid of a bunch of businesses that they don't really need and reinvest properly in the bank, in the retail franchise. And in all fairness to TD, their Canadian franchise has always done well. Like, I mean, when you look at their numbers, it's the Canadian side that's going along fantastically. It was just the US part that was really hard, right?
All right. So you'd like TD here.
Yeah,
You'd continue to add. Our second question is on Novonordisk. Paul has recommended Novonordisk in the past. Are you still a fan of the stock? Would he buy it here? This one coming from Barbara and Markham.
So I would definitely buy it here. I still own it. I've owned it for a long time. I didn't buy it because of the Wegovy and Ozempic. I bought it because they were the largest producers of insulin in the world. And I found that diabetes is one of the fastest growing, type 2 diabetes specifically, is one of the fastest growing diseases in the world.
So you owned it before the Ozempic craze?
Yes, way before that.
Okay, so you're sitting on a nice gain.
Yes, yeah, very nice actually. So, but well, it's, from the top, it's come back down. So one of the reasons I'd buy it here. But so the issues with these drugs is that they are actually very effective. They do work. The problem, what's happened is I think that people overestimated not the growth so much, but the multiple of these companies, and then they kind of had a little slightly slower growth, and they're also coming out with new drugs. So they came out with a study on one of their drugs. They said it was going to drop weight by 25%. It dropped weight by 22%. They dropped the stock by 20%. So this is because it was a high multiple company. But the issue that I think is important, there are two very important issues. One, from a competitive point of view, yes, there are the competitors, but most of those competitors are in phase 2 or phase 3 trials. Even if they get FDA approval, they have to manufacture the drug, which is very hard to do. And not hard to do, but it is complicated, and they have to grow manufacturing and get capacity. So that's one thing that's a problem. The second thing is that, which is a very important part about these drugs, is that overweight, obesity, all these things called increased chronic disease. And that's the biggest problem in healthcare today. It's chronic disease. It's not, if you're overweight, you have problems. You have to get hip and knee replacement. You're very susceptible to, heart disease and aneurysms and all these other things, right? So there's a sleep apnea. I assume you're from India as well, as I'm from India, but there's a large problem in the Indian community with heart disease and overweight. So this is really a big problem around the world. And so we need to, and it's not only in North America, it's in China has a large overweight problem as well. So it really does help bring down weight and help bring down the chronic diseases. The issue is that it's only given by insurance companies if you have diabetes. Right. So at some point in time, the world's going to realize that bringing down chronic diseases with this drug is far more helpful than sending people to hospital, right? And getting them surgeries and all these other things. And yes, you have to keep on taking it for the rest of your life. So what? We take statins for the rest of our life. We take, Crestor and all these, there's tons of people on Crestor. It's just, this is more expensive, right? But that is it. So I think that those two things make a huge difference. And I think the stock at these levels are probably is worth buying. The other company is obviously Eli Lilly, that is the competitor.
Well, that's what I was going to ask, because Eli Lilly has held up so much better than Novo. I own Eli Lilly, but actually I'm like the one person who's down on it because I bought it at the wrong time.
So the difference is that Eli Lilly is a much bigger pharmaceutical company, right? They're doing a lot of other they're in all kinds of other pharma. And,
like a big Alzheimer's place. So they've got this, but then they're potentially
they've got all kinds of other drugs that they're working on. And so is Novonordisk, but their franchise is substantially smaller, right?
So why not diversify and own a Lilly, which gets all that diabetes stuff that you're looking for, plus other things?
Right. So you said at the beginning that I bought it way before and I have a massive gain. So, listen, I think you should own, if you can own both of them, you should own both of them. Right, because I think this drug is going to substantially grow even faster than people think.
But you would buy the dip in Novonordisk?
Yes, I would buy the dip in Novonordisk.
Let's move on to our next question, which is Target. Target actually reports this week. What are your expectations for Target? Do you think shares have bottomed out? Would you buy it here?
So I don't particularly like this kind of retail companies. So, it's not an expensive stock by any means, right? I think it trades around 13 times earnings. It's got a good dividend yield. I just don't like this kind of retail. I just go buy Amazon. It's a way better at retail. And I think it's just a much more difficult retail environment because there's always this issue about inventories and, a lot of other things that And Target's, don't get me wrong, Target's probably one of the best companies at this. But it's to me, it's just there are too many issues in retail that are stumbling blocks, right? Whether it's kind of inventory management, where they make a mistake, they order too many things, whether it's, people, they're the kind of idea that people don't, yes, they go to stores, but they tend to buy things online, all these other things. It's my preference is to own somebody like an Amazon, right? Which I think is a lot better at growing a retail franchise because they don't have any of these issues. Well,
let me challenge you on that. Walmart and Costco, great examples, charts that move up and to the right pretty consistently. Yeah. Target, I love Target, don't get me wrong, but when you look at the sales, they are stumbling. Whereas Walmart, Costco, they're consistent.
You like to shop at Target, you're telling me. You don't wouldn't buy the stock.
I wouldn't buy the stock.
Right.
No. Which is odd for me, I know that. But because it doesn't seem like they've got a handle on their issues. They're also missing out because they don't have grocery.
Right. So there's a lot of different things. So even Costco, Costco trades at 54 times earnings. I own the company. It's very high multiple stock. But guess where they make a lot of their money? It's on the membership stuff, right? It's a huge, 90% of people renew membership there. And
you can't get into one on a weekend. You're taking your life in your own hands if you try to go to Costco. On a weekend.
when I go to the Costco with my wife, I sit in the parking lot and let her go, and it scares the hell out of me. Right? I don't want to go in that place. But it's unbelievable, and nobody walks out of there with, I'm just going to buy soap. They buy 500 other things, right? So it's a great. And
so is Costco an exception to your no retail rule?
Well, I think it is because Costco to me is a brick and mortar Amazon, right? They can keep prices low because they make a lot of money on membership. They've increased membership costs in the last little while. They have a Kirkland brand, which is incredible, which everybody buys. And they're very powerful retailers. I remember seeing Costco way back when I was at TD Asset Management, and I went to their offices in Seattle, and they were crappy offices. You go there, oh my God, this is the chairs were all broken, and they're just so cost effective. They don't care. They just want to keep costs down. That's their mantra. And they constantly are able to do that, right? And they've got very large purchasing power. And the idea is that you don't go there to buy, a thing of detergent. You will go to Metro to do that. You go there to buy 10 other things, right? And lots of them. A peanut butter jar that will feed you for the full year costs $7. Why would you go do that?
Why would you do that anywhere else? And they're also kind of getting into luxury as well and making it super accessible. I love passion fruits, but at a grocery store, it's $2 for a single passion fruit. And I went to a friend's house and they had a case of them. And I was like, oh my God, are they millionaires? What's going on? And it's Costco. They just are selling these passion fruit that are gold at a Longo's or something. Because exactly to your point, they're driving down the price of this stuff.
They sell clothing, they sell books, they sell everything, right? So it's a brick and mortar franchise that's actually done an incredible job. Now, you can make the argument that it's a high multiple. Don't get me wrong, it is. The other issue is that Walmart, which is not that similar, trades at a much lower multiple, right? But it's just got the formula right. And they continue to execute incredibly well.
Do you own it? You don't own it?
Yeah, I own Costco.
You own Costco. Yeah. Okay, so that's your exception to kind of no retail.
Yeah, that's I wouldn't buy a retailer like Target or
Macy's.
Macy's. Why would you ever do that? That's the craziest thing in the world to do. This is the company that used their borrowed debt to go buy back their shares. How stupid is that? So
no to Macy's, yes to Costco. We're going to take a quick break. We'll be right back after this. For over 25 years, Raymond James has been helping Canadians achieve their financial goals. They are Canada's largest independent financial services firm with over 520 dedicated advisors, $88 billion in assets under management, and capital market services. With no proprietary product to push, their advisors are free to focus on the unique needs of their clients. Whether you're saving for your children's education, preparing for retirement, or safeguarding wealth for future generations, Raymond James is committed to guiding you every step of the way. Visit raymondjames.ca today to discover how you can live a life well planned. And we're back. Our next question, this segment, is about the renewable sector. Could I get Paul's opinion on renewable energy stocks like Brookfield Renewable and Canadian Solar, who have suffered greatly in the past few years? Is there any improvement from here? This one coming from Biljana on X.
Right. So, I think the problem is with like Brookfield and all these guys, they're in this. Brookfield's a slight exception, but I'll get back to it. Why is that? I think it's a difficult environment for them, in the Trump world, because they really don't believe in renewables. They really want to push oil and gas, and so I think these companies are going to have a difficult time. This exception, I think, is Brookfield, which we own, and the reason I feel it's an exception is that they have lots of capital from the parent company Brookfield, and so in this environment, and this is what Brookfield has been great at over the years, is buying cheap assets. So I think that what they're going to be able to do is, because other competitors of theirs will probably have a difficult time and not be able to necessarily, grow their businesses in a world that says, we don't really care about what you do, they will suffer, and Brookfield will be able to buy assets at a cheaper level than they were before.
So you'd buy Brookfield Renewable?
Yeah, because I think that it may take a time. Don't get me wrong, but I think that that's what they will be able to do over a period of time, and that's what Brookfield has been very good at, right? Whether it's in real estate, whether it's in other areas, in infrastructure, and all these other places, they are very good buyers of assets because they understand the value of those assets, and so what they'll be able to do in this case, I think, as some of these assets kind of fall by the wayside and they can't grow. And a lot of it is because some of it is subsidized by government. So when you start to lose all those things, it becomes more difficult. So these guys will be able to, I think, buy cheaper assets in the hopes of the future, and they can stick around for a long time like that, whereas other companies may not have that ability to do.
And it seems like such a pendulum, although for science, it's not a pendulum, right? It's sort of a one-way direction, but the markets have a different opinion. So you had, like, a few years ago when this was the zeitgeist, company like BP going into renewable energy.
Right.
Now they have an activist investor saying, you better get out of renewable energy, only focus on oil and gas.
Right.
And so if they listen to that activist and have to sell the assets, are these the kind of things you're talking about that Brookfield, then they get to buy?
Yeah, they'll be able to buy assets maybe at a discount, or they could buy an existing company at a much substantially lower multiple and get all their assets. So they're, from a long-term player perspective, they're in the ability to do that, right? Some of the companies are not necessarily have that ability to fund themselves in that way, or they have to come to the market to fund themselves and they dilute shareholders and all these other things. Brookfield is not necessarily in that situation where they can, get capital very easily, right? So I think that it's a opportunity. It may take a lot longer than we think, but it's an opportunity because they can scoop up assets at lower prices, right? And I think the same thing happened, you saw with oil and all these other things. Like a lot of oil companies were in, either in oil sands and all these other places. They said, oh, we don't want to be there. And they had to sell off those assets. So some, companies were able to buy these things cheaper. So I think there's an opportunity for Brookfield to do that.
Okay, let's go to our next question, which is about Hershey's chocolate. And this viewer has purposely told us that they are looking for income and capital preservation. So that's how they're looking at Hershey. My question is about the longer term outlook. Is now a good time to buy again for income and moderate growth moving forward? And I like this question. It says, a recent market survey conducted by myself with my preschool grandchildren suggests that the long-term chocolate consumption thesis remains intact. I suspect Amber has come to similar conclusions with her own children. I have. That one coming from Rick in Calgary.
Right. So, Hershey's is it trades at 16 times earnings, got a good dividend yield. It's a company that's actually done a great job over the last several years of increasing margins, all margins, like, gross margins, operating margins, net margins. Its return on invested capital has gone up over a period of time, I think from the low 20s to 25.3 this now. So it's done a great job of running their business financially. And even in a period of time where you've seen, like, sometimes cocoa prices go quite high and have an impact on their cost structure, they've done a very good job of all that stuff. So I guess people are always going to eat chocolate, right? So,
is that why the stock is down? Because cocoa prices, which is a big input?
Yeah, I think so. So I think that, but that's a cyclical thing, right? I mean, that gets better over a period of time. So you can't worry about that on a short term basis. But long term is this is a great company. It's been around since 1894 or something crazy like that. So it's been around for a long time. It's in way better shape than it's been in the last maybe 10 years. So I think it'll continue to do well. It's got a great yield. Will it be more, given the fact that they've been able to do this with all these margins, I think that it's not going to be as volatile over the next several years. So if that's the case of owning those things, I think there's other areas if you want, income you can be in, whether it's maybe even the banks in the U.S. and stuff like that. There's a great opportunity there as well. So I think that is fine. I guess the issue to me is, owning a confectionery company. This is probably one of the better ones. I don't think there's many rooms there used to be a lot of room in consolidation in these areas, but there's not anymore. They've all been consolidated, and probably you can't buy anything. So you have to really go by organic growth going forward, right? And I think that the issue with a lot of these things, people are worried about these things because what we talked about before, Novonordisk, and how people eat less of these things.
Well,
right?
I was going to ask, the Ozempic effect.
Right.
Is that going to
probably have an impact
on
a
Hershey's, a Pepsi, Coke?
Yeah, I think so. I think they're going to have an impact on a lot of these companies. Alcohol companies have, I think, is another thing. People on these drugs substantially reduce their alcohol content.
So there was potential M&A activity around Hershey's. Mondelez was going to take a run at Hershey's.
Yeah, so I think it's hard to do because I can't remember if this is the case now, but Hershey's has a weird structure.
Ownership structure, which is owned by a foundation and stuff like that. So it would be very hard. The foundation would have to, same thing with Kellogg's, I think. It's hard to buy those companies because of the structure of where they were set up. They would have to want to sell.
They'd want to have to sell those things, right? But it's probably... It would be, I think, in stronger hands if it was with a bigger place like that, right? But I guess always the feeling with these companies, because it's in Hershey, Pennsylvania, so there's a lot of kind of dedication to the company, but also the people that ran the company, the history of the company, and all that stuff. So they may not want to be able to pass it on to a bigger place like that, which may destroy the value of that organization in a way that you wouldn't happen if it stayed by itself, right?
The last two questions before we get to your pro picks are about stocks that are in the so-called Magnificent Seven,
right?
Which the Mag 7 I'm coining is now the Lag 7
right.
in 2025, except for Meta, which is the strongest performer.
Yes.
And that's our next question. What do you think of Meta's valuation? What's your 3-year outlook on the stock? This one from John in Toronto.
Right. So, Meta has benefited a great deal from over the last little while. And this is one of my top picks talks about this issue, is that people have got this perception that with AI, they are able to benefit from it right off the bat, right? So they can use it effectively on advertising and all these other things where people don't feel other stocks in the same vein can do that. So I think Meta is able to generate better rates of return from AI. The other thing, of course, is there's a sense that it's free from all the handcuffs that they had with the Biden administration and all these other things, which give them a greater ability to kind of, in the marketing sense as well, to be able to do a lot of things that they wouldn't be able to do. It's not an expensive stock though, right? People think it's an expensive stock. It only trades at 20 times earnings, right?
And it just pulled back 10% from the high after earnings. So Is that a good opportunity?
Yeah, I guess what I would say is that I think that you probably will have a better opportunity at some point in time in the year to buy these companies, specifically Meta, because it's gone up so much, and it probably will fall more than the other ones. So that's what I think, and I think you'd be able to buy it. But this is a company that generates incredible rates of return. It's got lots of free cash, and it has it has debt, but net debt is it has about $10 billion in debt, but it has over $77 billion in cash and short-term securities. So it's like all these tech companies, they've got an incredible balance sheet. The other thing I would say that's a possibility about this stuff is that they were restricted on acquisitions, right? Like they weren't able to do anything. And so in the world that they live in today, they may be able to do acquisitions in certain areas that they want to do that they may not have been able to do under the Biden administration. They definitely wouldn't have been able to do under the Biden administration.
Is there a public company you think they'd want to take?
I don't know if it's a public company, but they could even buy a private business that fills in some of the things that they need, but they would never have been able to do that with Lisa Khan there and all this stuff, right? That was just off the table for a lot of these companies, right? So I think that there's a sense that in Silicon Valley, there are areas that they may want to be in that they'll be able to go and buy these days. They don't have to build, right? And I think that that's for Meta, it's the way they've grown, right?
Well, and they have big spending plans in AI, so maybe rather than build, they'll buy. Speaking of AI, we got to talk about Nvidia, and I'm so curious as somebody who cares about compounders, likes things at an attractive rate, doesn't like cyclical businesses. Some place semiconductors are cyclical. What do you think about Nvidia?
They are cyclical. Certain kinds of semiconductors are very cyclical, obviously DRAM and all these other things, right? So like Nvidia beat all their numbers. I mean, I guess the issue is what are you going to do for me lately, right, sort of thing. So they beat all their numbers. I think Blackwell it looks like it'll be successful. And they've, I think Rubin's the next one that, there was one in between, but Rubin's the next one after that. So the issue with Nvidia to me is this: no one is even close to them, right? So, AMD, but AMD's nowhere, Intel's nowhere. So they're the only people in town. And so if you want to, you got to go shop at their place, right? So I think that's the issue, right? And I don't think that, so DeepSeek or whatever came out, first of all, this is a Chinese company. Who knows what the hell they're doing? Like, they could have bought things through Singapore and had the same chips and spent $1 billion, and then they spent only 10. Yeah. No one really knows, right? And so, but it reinforces AI, in my view. It just reinforces the fact that it's going to be a big thing. Whether computing comes down or not is not the issue to me. It's that it's going to be a big thing. It's going to be in everything that we do. And so, and I think it's kind of weird that, like, the brightest minds in the world at Microsoft and Google will say, oh, you have to spend this kind of money. And the Chinese company says, oh, well, we can spend $10 million and do the same thing. It seems odd to me, but what do I know? But I would argue that these guys are going to continue to spend money because they really see AI being a huge impact on their businesses, not today, but in the future. And I don't think that's, and they can only go to Nvidia. Right now, so
does that mean you'd buy the stock? Everybody has to buy from Nvidia, but would you buy the stock?
Yeah, I own it.
Okay.
I bought it when it fell.
When it fell after earnings?
Yeah, at $116.
Okay. Was that for the first time, or you've been?
Yeah, the first time. I did the work on it before, but it ran up on me, and I was kind of foolish. But anyways, but I think that that's the problem, right? There's no other player in town. Now, it may go back to those levels because of all this stuff happening, but the reality is that there's no other player that can actually do the things that they're doing, and people need their stuff. Now, that demand will even out over a period of time, and I think that that's what's slowly happening. But I think that they're still going to be, obviously they're restricted on China as well, which hurts them. But I think that they're the only players that you can buy stuff from. AMD and the other players are just not there, right? And so I think it's the best company to own. So if you go back to my issue, you want to own the best business. They're the best business, right?
All right. Well, let's get into Paul Harris's Pro Picks. Pro Picks is brought to you by ATB Financial. With $62 billion in assets, ATB Financial is powering possibilities for more than 820,000 financial services clients in Alberta and beyond. ATB's capital markets arm is a full-service investment dealer that offers investment and corporate banking, sales and trading, institutional research, and risk management. Visit atb.com/inthemoney for more information. All right, Paul, your first pick here is a Mag 7. It's Alphabet, which, owns Google, owns a bunch of other things. Why do you want to buy it here?
Well, so I think Alphabet is the most undervalued tech stock around. It trades at 20 times earnings, below the market multiple. It has, kind of so many levers of growth, whether search is not going away, and even AI search they talk about all the time, but search is still a very big thing. When you look at YouTube, continues to grow. I mean, if you want to
we love YouTube over here at In the Money.
Like if you want to build anything, you just go there and you look at it and how to figure it out, right? So, and also YouTube is growing because of more and more things, like specifically what you're doing, even, are all moving to these kind of media, right? It's not even live sports, which was really important to traditional media, is moving to these kind of areas. So that's the second thing, is that it continues to grow there. And they haven't really, I don't think they monetize YouTube as much as they could. And they have a cloud business, which continues to grow. So they've got three really strong businesses. The fourth business, which no one gives them credit for, is Waymo, right? Which has far more data than Tesla ever has a robo-taxis all over the world, not all over the world, but in the United States. And they have lots of data. And so they value Tesla at some ridiculous multiple, but they won't give the same thing to Google. So those are the four things. Right, digital advertising continues to grow very rapidly. It's well over a $500 billion business in this coming year, and Google has 30% of that business. Right, so and people don't advertise in newspapers anymore. I mean, I remember getting the Globe and Mail. There used to be tons of articles. Advertising. There's nothing in it anymore. So the reality is that this is the way you advertise. This is the way you grow your business. And AI will have an impact on every one of those businesses. And they are a leader. I mean, yes, they stumbled in all these other things, but they are one of the big leaders in AI.
It's so cheap, and that almost makes me nervous. Like, why is it so cheap? Because it is so dominant in all these places. And is it because, like, yes, they still have the market share in search. I'm ChatGPTing a lot more than every day. I do it more than I did the day before.
Yeah, but but the reality is that like a lot of traditional people still advertise on that area, right? And they're not going to go to ChatGPT because they may, and I'm not trying to say that it's not going to happen over a period of time, but I think when you look at the statistics on search, they're still number one.
Yeah, for
sure. They haven't lost market share.
Yeah.
And at the margin, people like you and me may use those sort of things, but the vast majority of people don't, right? Especially on your phone and stuff like that. So, and I think that they've stumbled on a lot of things like AI and stuff like that, which has hurt them. And I think there's a real, people are really worried that, maybe they're Anthropic or one of these guys is going to take over search from them in a big way. I just don't see it happening, right?
Your second pick is Stryker. A little bit different, not a tech stock. Yeah. It makes medical devices.
Right. So Stryker does medical devices. It does knees and hips and spine business. They bought a company called Wright Medical that does hands and ankles. And so it's a great business because they're, for one thing, is that as the populations get older, they need more of these things, right? So we have much older populations and they need hip surgery and all those things. And it increases the quality of their lives, right? A great deal. So that's one thing. And it keeps them out of hospitals, which is the other thing, and keep them off drugs. So that's the first thing. The second thing is that there's a bit of an annuity when you own Stryker from a surgical point of view, because surgeons don't kind of use one, knee thing and then the next day use another. They tend to stick with, because they're complicated little products to put together. And so once they learn how to use them effectively, they tend to use the same ones. The other thing is about 70% of Stryker's businesses in the United States, 20% of it is in the developing world, and then the rest of it is in undeveloped world, right? So there's lots of room to grow outside of the United States. Populations are getting older all over the world. And so that's a very important aspect of what they can do.
How much upside? It's already close to an all-time high.
Yeah, I mean, I think this thing compounds at a really good rate. I think there's a lot. I think it can do, 8 to 10% a year, but probably more, I would like to say. But I think it's a great business because of that. Like, it's just a really good compounding business, and more stuff is going to go to medical devices. And they do acquisitions, like they can do these tuck-on acquisitions constantly and grow their business that way too. Is
there going to be diminished need for hip and knee surgery because we're all taking Ozempic?
Maybe, but not as much as you think though, because those things deteriorate even in people who are healthier, right?
Your third one is interesting. It's a Canadian energy stock, Canadian Natural Resources. You don't like cyclical businesses. You don't like mining stocks, but you've got an energy stock in there. Why?
Right. So I like C&Q. I've owned for a long time, and I've always felt it's just been the best Canadian oil company around. Right. They've always executed incredibly well. When they've done new projects, they've always come in on budget. It's unbelievable that this is a very special company here. And the other thing that they're very good at is buying assets incredibly cheaply. Like, Suncor's done it but these guys have done it, and they've done it incredibly well. So I like that aspect of it. The other thing I like about what's happening in the oil and gas industry is that they are, like many large cap oil companies, they just realize that they got religion or whatever, but they take their cash flow, which is a lot, they buy back their shares, they pay down their debt, right, and they reinvest in their business, right? And I think that those are the keys of what they've done over the last several years, and you can see the better returns that they're getting on their invested capital, right?
And yet the stock's trading at a 52-week low. It is underperforming.
Right. So that's partly because of the price of oil, obviously, right? So oil has been locked in.
Yeah, but it's underperforming peers as well.
Yeah. So I mean, I guess it goes through these little periods of time where it does that. I think oil prices should be somewhere around between $80 and $90, and that's a fair value for oil. And so it's, below where it should be. In a world that's growing and everything's fine, right? Maybe that's not going to happen, but that's where it should be. But I think it's a company that you're not paying a lot for it, and you get a great dividend, and so it kind of pays you to hold it. But it's a really well-run Canadian business, right? And like I said, there's not that many of them around, but I think this is one of them.
All right, Paul, it has been so great to have you in studio. Thanks so much for joining me.
My pleasure. Thank you for inviting me.
I learned a lot. Thank you so much as well for tuning in. Make sure you catch our next episode. We've got David Burrows on the show. He's of Barometer Capital. He talks pretty much all large companies in both Canada and the U.S. You can get your questions at inthemoneypod.com. Find us anywhere on social media at InTheMoneyPod, and we'll see you on the next episode.